What's going on, everyone? Hootmoney here with another video for you guys today. Today, we're going to be talking about the stock market crash of 2022, when this thing could exactly bottom, and how you guys can use this information to make a boatload of money in the future. So if you guys appreciate this content, drop a like on the video, subscribe to the channel for more. With that being said, let's get right into it. All right, so here we can see the chart of the S&P 500. We're looking at 2018 because 2018 was a similar year where the thought of higher interest rates actually created a very choppy market. So I pulled up a bunch of different articles from different points in time, right here, and right here, and we can look at what policy changes from the Federal Reserve, what events were occurring at the time that could actually be a catalyst to us making some money off of it. We're also going to look a bit more macro and see if this was a buying opportunity or if it caused a major market crash. Before we get into the juice of today's video, I'd like to thank the sponsor, which is Moomoo, a licensed FINRA broker that does absolutely zero payment for order flow. As you guys can see, they have a promotion that they're running where you deposit $1 on their platform, you get up to $7,000 in free stock. On top of this promotion, you also get a free share of AMC stock if you deposit $100 on their platform. Honestly, I think their promotion where you deposit $1, you get up to $7,000 is an absolute steal of a deal. And you can do this by using the links below in the description or pinned comment section. You have to click the link in order to get this deal. So all you got to do is click that link, make an account, connect your bank account, and deposit $1 to get up to $7,000 in free stock. Again, the links are below. But with that being said, let's get back into the video. So first things first, I want to look at what kicked off this whole choppy market. So we're going to be looking at the end of January 2018, beginning of February 2018. They have this article right here saying Dow plunges 666 points, worst day since Brexit. And similar to what's going on right now, analyst Peter Bookvar mentioned that it's all about rates. Asset prices in the economy have become addicted to low rates, very similar to what we're seeing here in 2022. The 10-year Treasury yield also reached a 4-year high of 2.85%, and you can see the chart right here. It started steadily climbing up since September 17 all the way to February 2018. You can see that currently the 10-year Treasury is also increasing. It bottomed out here in August of 2020, seeing a short-term high in April of 2021 right there at 1.72, coming back down to 1.26, and now we're currently sitting at 1.93. So when the Treasury rates increase, it inflicts panic, it inflicts fear in the markets because these rates are so closely tied to valuation, especially in companies that don't generate profit currently, which is why we're seeing massive declines in some stocks of these pre-revenue and non-profitable companies. So because of those fears, the market had a nice little 12% correction and remained choppy through the end of May 2018. So the first half of the year was very, very choppy, but at the same time, after that 12% sell-off, the market ended up rallying another 17% until October of 2018. So here's an article from October 2018 saying that the Dow plunges more than 800 points in worst drop since February. Amazon and tech shares lead the rout. And again, for the same reason, rising rate fears and a pivot out of technology stocks have made it a rough last few days. So it's still about rates. So this ended up leading the market to sell off another 20%, bottoming out around Christmas of 2018 or December 25th. As the market bottoms, this article was published. The Dow rallies 1,000 points, logging its biggest single day point gain ever. Now, what ended up happening was that on December 19th, so about a week before the market bottomed, the Fed hikes rates and lowers the 2019 projection to 2 increases. Now, this was down from 3 rate raises that was previously projected. And as you guys can see from the market lows, the stock market did rally another 27% before having some selling pressure. And again, looking at the 10-year Treasury rate, we're looking at November of 2018. This was when we saw a top in the 10-year treasury, and then it went only down since then. So by looking at the 2018 case study, we can determine that the stock market is heavily influenced by rates and the Federal Reserve's monetary policy. Looking at the current stock market, the sell-off was about 12%, bottoming on January 24th, 2022. Very similar to that sell-off in early 2018 right here. We're currently sitting at about a 9% sell-off, so 9.44% sell-off from the levels that we've seen at the peak over here, the beginning of January 2022. So based on what happened in 2018, I think it would be a relatively safe assumption to assume that the choppiness that we're seeing right now in the stock market may end up lasting until the end of 2022. And a lot of the time, once the Federal Reserve actually does increase the interest rate, it's a buy the news event. So the market typically sells off when there's a rumor of the Federal Reserve increasing interest rates, and it rallies when it actually goes into effect, when we actually get higher interest rates. So currently we're looking at a potential interest rate hike in March at the next Federal Reserve meeting, as well as July. So we might have a choppy market up until this range right here. But afterwards, it may get a little bit better. Again, this is all speculation. No one really knows what's going to happen with the markets. And then I want to look a bit more macro at this whole situation as well, because it might seem like, oh, the stock market's going to be terrible. It's not going to go up at all in 2022. Well, if we just look about 4 years back, if we go back to the peak of 2018, in January, the stock market is up about 62% from that point. Also, again, if we look at 276, which was the highest the stock market was in 2018, we are still up 58% from that level. So just because there are some rate hikes doesn't mean the stock market is going to crash. The stock market needs to correct itself. It can't just go up forever in order to be sustainable. So corrections are okay, but calling everything a stock market crash, especially when it has to do with interest rates, I just don't think that's a valid argument, given that the stock market has gone up 60% from 2018. And if we look at some of the dips that were created in 2018, they happen to be very good buying opportunities as well. Now, I want to look at a different sector of the stock market, which is the growth sector, because the growth sector did not start selling off in December of 2021, similar to the S&P 500. The growth sector started selling off all the way back here in February of 2021. So that was almost 10 months prior to the S&P 500's reaction. And this was also on the news of potential higher interest rates. So as you guys can see, we're looking at ARK-K, which is Cathie Wood's ARK Investment main flagship ETF that they have. I think it's pretty safe to say that ARK-K is basically the benchmark for growth right now. You can say what you want about Cathie Wood, but it's definitely following the trajectory that a lot of growth stocks have faced, which was peaking out in February of 2021. So as you guys can see, this stock or this ETF is sitting about 56% down from its all-time highs right now. You can also see right here a list of stocks that have seen major declines. You can also see this tweet right here citing a Bloomberg terminal that stated that the number of NASDAQ stocks that have now hit a 52-week low dwarfs that of the 2000.com bubble and GFC. So they speculate that maybe the bubble's already popped. And here you guys can see it. So this would be in 2008, the number of NASDAQ stocks that have hit a 52-week low. This would be in 2002, the number of NASDAQ stocks that hit a 52-week low. This is what we are seeing right now in 2022 as we speak. It completely wipes out what happened the last two financial crises. So what this could mean is that since a ton of growth stocks have essentially already crashed, we saw Cathie Wood's portfolio is down about 56% from its all-time highs. Since these stocks have already crashed, it could mean that higher interest rates have already been priced in these stocks, and that there's a ton of stocks that are on seriously deep discounts right now. The growth sector historically always reacts the most to interest rate changes because they're typically pre-revenue or non-profitable companies. So when you're valuing this, it depends a lot on the cost of capital. And if the cost of capital is high because of high interest rates, it makes the value of these speculative growth companies a lot lower. But in the case of the growth companies that we are seeing currently, a lot of these companies have already priced in that increased cost of capital. And at the same time, a lot of these companies have amazing balance sheets because they have raised an ample amount of cash. So in my personal opinion, there are tons and tons of growth companies that are seriously undervalued right now, and you just have to seek them out. But it might take some time for them to go back to that price, and it might be choppy for some time before you actually get those returns that you're seeking. Now, I tweeted this out yesterday, so here's my plug to go follow me on Twitter. It's hard to imagine that there is much more downside risk in the markets unless there's some financial crisis that I'm unaware of. Worst case, I see the S&P 500 going to 4,000 and Bitcoin going to 24,000. This essentially means that going long has more upside than going short. And again, we can go back to 2018 where the market was getting spooked by higher interest rates. It sold off about 12%. But if you just held on to it back to all-time high, you would have made 63%. So obviously going long make more sense than going short. You can say the same thing about the other sell-off in 2018. You could have made 20% by going short on your bet. But if you just went long instead, you'd be up about 61%. So it is pretty obvious that when the S&P 500 is down, it is usually a good buying opportunity as long as you have a long-term outlook. If you're thinking 5 years or more, you shouldn't be spooked at all. This should be nothing but a buying opportunity. Now, the stock market is also getting spooked out by the potential Russian invasion of Ukraine. Bunch of people are saying the VIX will 10x. I say that's highly unlikely because in the past, geopolitical events have sometimes taken the market down greatly, but if we're looking at the total drawdown here, they usually don't have a significant impact on the stock market. You can also see here that historically speaking, when there are invasions that blindsides the world, it's usually a by the invasion event. It happened in Vietnam, it happened in the Gulf War, happened in Afghanistan, it happened in the Iraq War, it happened in the Crimean crisis, which was in 2014 when Russia took Crimea from Ukraine. So very, very similar to what actually happened now, but that was a by the invasion back then, right? So all in all, it's reasonable to believe that the markets will go down or be choppy from this point. In fact, I do think that if everything gets priced in terms of these interest rates that are going to be coming in 2022, the market should technically go down a little bit more. But if we're looking at a more macro perspective, almost every single dip in the S&P 500 in history has been a buying opportunity as long as you have a very long outlook. If you're thinking more macro, none of this news, none of this fear, none of this FUD should matter whatsoever. Also, a war isn't going to crash the markets. I mean, it's very, 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 very highly unlikely that it's going to crash the markets. Markets have almost always recovered from war as well, and it's usually not made a huge impact. The market definitely cares more about interest rate hikes than the war currently. So again, that's something I would see as a buying opportunity, not as the VIX is going to 10x overnight type of opportunity. Anyways, guys, that's about it. I hope you guys enjoyed. Drop a like if you guys did. Subscribe to the channel if you are new. And check out Moomoo if you want up to $7,000 in free stock, as long as you deposit $1 on their platform. You can find that link in the comment section down below or in the description of the video. Also, if you want all of my buy and sell alerts, if you can't make it to my daily live streams, you also want to join a private Discord with me and other VIPs, you can find Hootmoney trade alerts using that first link in the description below. Anyways, that's about it for the video. See ya.